Welcome to the big interview on the February 9th edition of Money Life. Joining me now, Jeff Rosenkranz. He's fixed income portfolio manager at Shelton Capital Management. He specifically manages the Shelton Tactical Credit Fund. If you want to learn more about him, the firm, and the fund, go to sheltoncap.com. Jeff Rosenkranz, great to have you back on Money Life.
Great to be back with you. Thanks for having me.
You know, I seldom think of the fixed income world as being like, oh, we're busting with news here. But in the last week, well, we got a little bit of news because we have been living in a time where the market has been pricing in 6 Fed rate cuts this year, though I have yet to talk to anyone who actually thought we would get that many, but the market was thinking it. And then Jerome Powell goes on 60 Minutes, and now it's been like, oh, maybe that's not going to wind up happening. So let's start there. Has anything changed in your mind in terms of when the Fed will cut and what the cuts will look like? Is this going to be wait for longer but get a bigger cut when it happens? Or what's going to drive the narrative here?
Great question. The market's been trying to get this right for going on a year and a half now, right? Front running Fed cuts, the Fed pushing back against the timing of the first cut and maybe even the pace of those cuts. And so, as you mentioned, Powell was on 60 Minutes, thought he did a pretty good job. They're looking for a little more confidence that we're on a good path towards inflation not just coming down, but staying down. They're deathly afraid of this thing reaccelerating or becoming entrenched, because if they have to somehow quell inflation that rears up again, it's harder and the landing is just even bumpier. So they're going to wait a little longer. Exactly how much longer, I don't think they even know, but March is off the table. May is probably still on the table. May, June, kind of feels about right for that first cut. Because if they wait too long, financial conditions are going to stay tight and they risk a harder landing that way as well.
Okay, so if they are risking a harder landing with no action, and that leads you to believe that they will act, are you pricing a soft landing into your expectations?
Well, this is where it gets interesting, because everyone and their mother is expecting soft landing. That's the prevailing conventional wisdom in the markets. And so anything outside of that could bring on volatility. When everybody is on one side of the boat, so to speak, that makes us a little bit nervous, and we spend time thinking about what could go wrong or what could diverge from that prevailing view. And that's where we come back to, if they wait too long, which they might wait too long, or if some of these systemic things rear up again, there's a lot of ways that we could get a harder landing that the market's just not as focused on. So we're not saying it's definitive that we're getting a hard landing, but we think there's a greater possibility than is being incorporated into market pricing right now.
What that is saying is that the economic data and the strength of the economic data that we've had is maybe not as strong as it's made out to be. I mean, that the economic forces, things like the inverted yield curve and the rest, which have long lead times until they come into effect, that they are actually going to play out. Do they play out this year, given that you've got those forces against the force of an election year, historically benign for the market?
Yeah, the transmission mechanism seems slower this cycle. We know that tighter policy operates with a lag in terms of when it actually starts to impact and slow the economy. And this time feels like an even longer lag. And we think that's largely because so many people locked in really low mortgage rates and don't need to refinance. And a lot of people locked in auto loans and leases at lower rates. That's starting to change on the auto side, but these are the two biggest purchases that people finance with debt and where people feel the sting of these higher rates. And so over time, more people are either forced to take out a new mortgage or refinance or otherwise, but they've been holding off. And over time, more people need to step into new cars, loan, lease, whatever. So eventually, these higher rates bite more and more. I just think it's taking longer this time around. And so we still think there's more impact from all this tightening to come. And then on the corporate side, which drives a lot of capex and business investment decisions, large companies have wide open access to the debt markets, but smaller businesses are feeling the pinch, and they are the ones that borrow from local banks, community banks, regional banks, who still have some stress. And the cost of capital for smaller companies is problematic. And so the longer that rates stay high for those types of borrowers, which are huge drivers of employment and creators of employment historically, the more impact it's going to have. So we're not out of the woods in terms of the impact of these higher rates. But if, as you point out, if the Fed looks at recent strong economic data and thinks, oh man, this could reaccelerate, or maybe the economy really is strong, well, then they're going to wait, keep rates higher for longer. And if it turns out to be just a head fake here on some of this economic data looking strong, but maybe not as strong as it actually is, that's where you could get into some problems where they left rates too high for too long. And then the transmission mechanism, kicks in more at the same time. And so that's where you could have a bumpier landing than is priced into markets.
I'm glad you got into the debt conversation. I should have pointed out Shelton Tactical Credit Fund is ticker symbol DEBTX, DEBTX. You left me a bunch of different directions I could go off of that last answer. I guess I need to go back to the idea of what we're seeing in the banking industry first. I mean, what it sounds like we're going to get a wave of defaults, and I want to talk about junk in some time that we've got, but you also talked about banking stress. We've seen a few signs, smoke signals that maybe the worst of what we saw last year could be over, but was not done. Like there could be other things happening. So how worried are you that the banking crisis we got into last year is not done and that the next chapter is about to unfold?
We don't think it's done, but we also don't think it's systemic. So we don't think that there will be enough stress to create significant systemic issues, but there certainly are going to be individual financial institutions that fail. New York Community Bank is in the news over the last week or two. They bit off more than they could chew. They went over the $100 billion cap to face further regulatory scrutiny with their acquisition of Signature Bank assets just last year. And they have some issues. And I don't think they're an isolated case. We know commercial real estate asset values are down, and it's just a matter of time where that asset liability mismatch, where these institutions are still borrowing at higher rates, but they have long-lived assets whose values have decreased precipitously. So there will be more, but we don't think it's going to be systemic and bring down the entire financial system like '08 or something like that.
Trouble in the banking sector, you said we're going to wind up seeing more problems come to roost in terms of credit quality and potential for defaults. Junk bonds throughout all of this have not gotten junky. We haven't seen a significant wave of defaults. Are they going to get junkier? And if so, are they worth the risk at a time when you can get some decent yields without having to go that far out the credit scale?
We think high yield is pretty interesting, but you've got to actually do the work and distinguish between good credits and bad credits. The entire high yield market, which, as you know, includes everything from BB down to CCC and stressed and distressed bonds, we think there's going to be an increase in dispersion or winners and losers. And so if you do the work on the fundamentals of these credits, we think there's a lot of value, especially at the BB and B level, if the economy is going to remain relatively strong, that's good for these borrowers. Cash flow is strong. Leverage has gotten better over the last few years. So the credit stats are pretty good, and you can get attractive yields. Spreads are certainly tight, but even if spreads widen a little bit, it's likely that the risk-free rate component or the treasury rate is going to go lower over time. And so the net effect of that is we think you're looking at 6, 7, 8% kind of returns for the upper credit quality portions of the high yield market, with potential upside from there if rates grind lower. But where we would be careful, and where we are being careful, is at the lower credit quality component of the high yield market, the low single B, triple C space. That's where we love to kind of go treasure hunting or do our deep dive credit work to pick apart, winners and distinguish them from losers. And so we think there are going to be plenty of both. We think there will be companies in that lower credit quality bucket that are able to refinance because credit markets are wide open right now, or they get acquired by a stronger company. But then we also believe there will be some significant downside surprises in that space as well. You're starting to see it over the last 3 to 6 months, where individual companies have blowups, and we just think that's going to accelerate as we get further into 2024.
Jeff, I have more questions. Unfortunately, I don't have more time, but thank you for the time you've given us. We're going to pick up this conversation as we watch how it plays out later this year. I'm looking forward to that next conversation already. Thanks for coming on Money Life.
Likewise. Look forward to it. Be well.
That's Jeff Rosenkranz. He's fixed income portfolio manager at Shelton Capital Management, portfolio manager for the Shelton Tactical Credit Fund. That's ticker symbol DETX. SheltonCap.com. And we'll be back to wrap up this week on Money Life and let you know all about what's coming next week right after this message.